Hey, I'm Abe, and today we're going to continue talking about investing, but we're going to pull back for a second and we're going to look at it a little bit from a distance. Maybe you've stopped and you've thought, okay, I've got my budget set up, I've got some money that I'm saving now. How do I get some of that sweet investment growth and financial well-being that we've all been talking about? In the last few videos, we've talked about the various tools that you can use to invest and grow your money. So let's just do a high-level look back at what we've gone over and what we've learned so far. So initially, there are stocks, and this is what everybody thinks about when they think about investing. They're thinking, boy, I bet PG&E is a great investment. I think they're going to be doing really well. I'm going to buy PG&E and I'm going to get rich. Or I'm going to buy Apple and Apple is going to continue to do well and I'm going to get rich, or whatever it is. That I'm going to get rich option or idea is kind of where stocks live. They're relatively risky, and as a result, they have the potential for a high return over time. Along with that return, the risk also exists that you can lose everything when you put your money into it. So stocks exist. They are a core investing tool, but they are perhaps not the tool for you. They're not diversified. And in one of the next two videos, we'll talk about what diversification is and why it matters. But stocks, you are not an investing professional for the most part. I'm not an investing professional. I've got a lot of education, some of it in investing and finance, personal finance, and business administration, but I don't really even feel like I'm qualified to look at a company and assess whether they individually are a good investment. I have a sense, I have a feeling about it, but I don't trust that sense or feeling enough to really just say, I'm going to go and invest in this particular stock and everything's going to be great and I'm going to get rich, because I don't think I am going to get rich, and I don't think that I know enough to really make those calls individually. So my advice, avoid the stocks as individual investments. But going to the next one is bonds. And we've talked about this recently, and I think it's the last video that we published on Friday there. So bonds are essentially you financing companies and or governments or municipalities by buying a portion of their debt. You're saying, I will give you my money for a period of time and you will pay me interest over that time and then you'll give me my money back. That's it. It's just a loan. But the interest and the return that you get is relatively low. But that said, it can be and often is a very reliable and stable form of investment that you can get 3%, 4%, maybe 5%. I mean, it depends on where the interest rates in the markets are, but you can get a low level of growth out of your money above and beyond that of inflation. And depending on the bonds that you invest in, if they are high quality bonds or treasury bonds, for example, your money is not going anywhere. It will just grow slowly and steadily over time, and then you will get your money back at the end. Third option, mutual funds. Now, this is where stocks really come into play. Mutual funds, and the fourth one, which is ETFs. So mutual funds, this is where these funds, imagine one fund, it is a professionally managed collection of stocks and bonds. So there are whole teams of people whose job it is to analyze and research companies and determine what they should invest in. And the fund will be invested in hundreds to thousands of different stocks, so that if one goes really high, you get to benefit from it. But if one goes really low, you get hit, but not very much, because it's one of 1,000 different stocks or companies that this one fund is invested in. So mutual funds are where you kind of want to start thinking about bonds and mutual funds and ETFs. So mutual funds are really diversified. They have some costs associated with them because there are all of these teams of managers and researchers and financiers who are doing all of the due diligence that you are not doing or not able to do. And so you're paying them with the assumption that the amount that you're paying them, you are getting back more than, so like let's say the fee is 1%. If the market returns 10%, you would hope that by investing in this mutual fund that you get at least 11% back, because they're doing all of this research and all of this work to help their choices and their investments perform better than just the market by itself. So to add value or to be worth what you're paying them, they need to provide you more return than they are charging you. So mutual funds, managed, very diversified, but generally targeted. So you may have a bond-specific mutual fund where they've gone in and chosen a whole bunch of very specific sector bonds, or they want to invest specifically in the tech sector. So this is a tech-specific mutual fund. Maybe it's specific to small cap stocks and small companies. Maybe it's only large and established companies. Mutual funds are a great tool. ETFs are primarily, they're very similar to mutual funds. They have much lower costs. They're very cheap by comparison. And primarily, they're not actively managed. So mutual funds, there are people buying and trading and changing their portfolio over the course of the year. Maybe not significantly, but there is active management going on. ETFs, on the other hand, are more passive. A lot of times an ETF will track an index or a market specifically. So it will say the S&P is what this exchange traded fund will follow. And it is a representation of that market. So buying that ETF or that exchange traded fund allows you to essentially buy the market as a whole. And so if the market goes up, this will go up. If the market goes down, this will go down. But it is a whole collection of stocks similar to a mutual fund, but it is not actively moved around. People are not shuffling stocks in and out for the most part. If you can invest in ETFs, you get all of the returns that the market gets, which over the last 10 years has been great. 2007 to 2009 or 10 was very rough, but over time, if you look over the long term, the market grows at a decent rate, somewhere between 6 to 8% if you want to be conservative, a little less conservative, 8 to 10%. And as we've seen in our compounding interest video, you know that over a long period of time, that will grow your money significantly. We're talking 10-fold, 100-fold. Stocks, bonds, mutual funds, and ETFs. Mutual funds and ETFs make up or invest in stocks and bonds. So I'm not saying, and maybe you shouldn't consider investing in an individual stock, and maybe you shouldn't consider investing in an individual bond, but check and look for ETFs and mutual funds that do invest in stocks, that do invest in mutual funds. And if you have one company where you're like, man, I really think Nvidia is a strong company, or I really think, I don't know, that Ford is going to do really well next year. Well, go and find a mutual fund or an ETF that has Ford in it, and then use what you think is your knowledge of that industry or that company to pick a mutual fund that is heavily invested in that specific stock, so that instead of you putting all of your eggs in Ford, you put some of your eggs in Ford and let somebody else manage all of the rest of those eggs, so that if Ford doesn't do great, you're not losing all of your money. That is the risk of stock investing. So stocks, bonds are the bread and butter that go into the sandwiches that are mutual funds and ETFs. These are the 4 tools. I would recommend really primarily only investing your money in mutual funds and ETFs and doing as much research as you can. There are sites like Morningstar, which is what I use, Barron's, and other sites that research and review how the performance is doing of these various mutual funds and which ones you should consider, what sectors they're exposed to, and what their top 10 holdings are. And these are things that you should be looking at. So check out my individual videos if you want to learn more about stocks, bonds, mutual funds, and ETFs. And in the coming videos, we'll talk about what diversification is and why it's important. And as with previous videos, if you want to see math for any of this stuff, if you want me to break down what diversification means and why it's a successful philosophy in math and on a spreadsheet, I'm happy to do that. I can do that pretty easily, and we'll go through that. Or if you just want to see the return rate of bonds and how that structure lays out over a calendar, I can do that as well. So you just tell me what you want to see, and I will cater the next few videos to you and what your curiosities are. This is the essential basket of investing, and this is how you take the money that you've saved and grow it into something really significant over time. This is the essential ground floor of financial literacy and financial independence in general, that understanding what your options are and understanding how people are using their money to make money will allow you to be more informed, allow you to make those same decisions and benefit from those same structures and those same mechanisms. And it'll set you and your family up for greater success and stability in the life to come. So thank you for watching. Hit me up with what questions you have and what you want to learn about next, and we will get into it from there.